How's it going, everyone? Thanks for listening. I'm going to give a quick overview of observations of why retail speculation, short-dated options trading is never a winning. It's never a winning situation if you're a trader. For instance, one of the biggest things is I'm going to pull up the two treasuries complexes. So let's look out two similar dates, 17th or the 10th of July. Here, we see that for the 10th of July on the ZB contract, which is roughly the same duration as the TLT ETF, we have a priced implied volatility of 8.26%. And I didn't even look at this before. Like, we're going live in this example. So this is just to show, like, I'm so confident in this market structure that, what do you know, when we look at the 10th of July on the TLT, it's 10.12%. What that means is the at the money spot is 2% richer on the iShares TLT ETF than it is on the ZB. And this isn't just for bonds. Let's do ES. Let's do ES. And let's do SPY ETF. And we're just going to continue, and we're just going to go down the line comparing liquid futures options, which are mostly institutional, and the retail equivalent. Let's look at these zero dated. What do you see here? Zero date on the ES. The chain at the money is 7.23% on its implied volatility, and it's 25.59%. So if you're a retail speculator and you're on those zero dated options, a dealer is simply just going to sell you to it for an 18% implied volatility at the money markup, and they're just going to hedge with, what do you know, one of these long E-mini S&P 500. And you might say, well, there's more open interest here, but you got to remember from my previous calculator videos, one of these is worth 5 of these. So if the 11 delta has 2659 open interest, what does that mean on ES? Roughly the 11 delta there, only you can divide that by 5, 400. So roughly here, what do you see? Roughly 400. So you see the market structure because the hedge ratio isn't exactly 0.1, but because roughly it takes 5 ES options to hedge one SPY option. What you see is roughly you can divide all this open interest by 5, and it's over here. And what that is that's hedge funds, that's dealers, and that's institutions providing that rich 25.85% implied volatility on the zero-dated complex, and they're hedging with the 7.27%. And I used to trade zero-dated, I used to trade short-dated options, and I was looking for retail harvest as well. I wasn't doing like convexity long or price action speculation. And I can tell you, this is the richest I've ever seen ETF premium since the bull run post-COVID. Lots of open interest. You can see almost directly divided by 5 hedging on the ES. And it's probably going to be similar with the NASDAQ too. Let's look at the NASDAQ complex real quick. And this is just to show exactly why, if you are an ETF trader, it doesn't matter if you're short options, long shares, short shares, you are simply the liquidity. 11.41% implied volatility on these zero-dated NQ options. Let's look at the QQQs, 39.07%. That is a 28% markup on the QQQ options, and people trading zero-dated are just simply getting hedged on this. They're getting hedged on similar products. I mean, look at that, 39.07%. That's insanity. That's retail driven. I mean, look at the open interest all throughout this chain. It keeps going deep. I mean, we have like these sub-1 deltas. This is massive gambling. That's the only way to put it. Let's maybe look at the CL complex, the crude oil complex, versus the retail USO ETF. And I'm not sure about this one, but we can see right here, let's look at 1 day out, 40.26% implied volatility on one date, 56.35. So even on the oil has a premium of about 16% implied volatility on the same date. Now, I'm going to make a point. The further out in time you get, the richness of the ETF disappears, and there's structural reasons for that. First of all, there is massive dealer risk as you provide liquidity to these short gamma options and PFOF, other such variables, means there's more premia the dealers want. Another reason is just the sheer volume. I mean, let's look at those and look at the sheer volume of open interest we have on the USO options. It's massive, and this is a lot of your Wall Street bets crowd. Now, how would you trade this as a dealer, as an options broker, and whatnot? It would be quite simple. Let's just do two charts. Let's get this. You would just simply trade this as a relative value. So how you would trade, let's go to the liquid SPY for a second. So SPY versus ES. What you would want to do here is you would want, let's look at these 2 days out. 2 days out. Let's just expand the chains for a second for this. So I'm just working off the numbers here, and let's just get our Greeks. What you could do here is when you look at the chain, let's look at a 10 delta. Do we have a, so do we have a 10 delta on the ES we can look at? Here we go, here's a 10 delta. What we would do here is with my previous videos explaining hedge ratios, etc., and so on, what you see is it takes roughly 5 ES options when you're doing single longs, not spreads, to equal, or 5 SPY options, forgive me, for 1 ES option. And the reason why it's not 10, like how the SPY SPX complex works, is the ES has a contract multiplier of 50. So what you would do if you wanted to trade this premium, and we're just going to do a single leg example here, is we would set, let's just do units of 5. So we could sell 50 SPY 10 deltas, and then for our delta neutral, we would buy 10 ES 10 delta. And the trade here isn't as directional as a traditional credit spread. Obviously, because your short leg is on the puts, you're hoping for everything to expire worthless. There's a bit more quant and hedging noise if you start getting into being assigned on the SPY, and then you're going to have to look at cash behavior on the futures, and it's a bit messier. So still, you want to trade this like it is a vertical spread, but you are engaging in a delta neutral market-to-market relative value trade, and that's how you would initiate the setup. Now the next step is when you are in a trade like this and you're short the SPY, long the ES in a sort of delta neutral relative value trade, you're really exposed to liquidity. And let me explain that for a second. Let's get ourselves just a full chart. What you are kind of exposed to is financing conditions. So I will give a proxy for that. So let's do the SR3 of September of this year. And let's just subtract that by the March of next year for a second now. And let's just look at that, look at a calendar. Actually, I'll just pull it up with this. This would be a better example. So what we could do here is we could look at the product depth. We could look at this term structure here on SOFR. And even though intuitively you're thinking, I'm just talking about equities options, why are we now diving into SOFR? When you're doing a delta neutral, providing liquidity on the ETFs, hedging that with the cheap options on the futures, you are now kind of playing a dealer balance sheet. You're playing a game similar to how a dealer would operate. And now, when you're that delta neutral hedge, you're more exposed to funding. So if you see a quick steepening, a quick flattening, or distortions on the term structure within repo, that is a sign that maybe that delta neutral hedge might start breaking as dealers start to break. So ways to actually hedge that isn't just what you would want is to have maybe long options or variant swaps on the S&P underlying or whatever underlying you're doing, but you might want to look for yield curve forward swaps. You might want to look for those longer dated SOFR contracts. You might want to trade the SOFR term structure as a shape itself. And you want to be very aware on leveraged delta neutral strategies where you are doing semi-liquidity providing of how funding is going to work. Another thing you would probably want to look out for is credit spreads. Now, I'm using the retail ETF proxy here, but another thing is the sort of net income valuations of equities, and I'm speaking about like the NASDAQ S&P example. It's really tied to the health of the lending. So you're exposed to dealer kind of treasury funding, but you're also exposed to corporate bonds, the spreads on it. So you would be kind of looking at spreads, and I'm using the proxy here. If you had an institutional terminal, you'd have cleaner examples, some swaps examples here, but you would be really looking, are credit spreads blowing out? Because even if the term structure on repo and SOFR is looking good, credit can be the canary in the coal mine for these strategies, and you've got to be really aware. So I say all of this to go to the original point. There is an excellent trade right now. If you have a disciplined quant team, if you're following expected value and you have correct position sizing of being an ETF provider and looking at hedging with futures options, but there needs to be macroeconomic, repo, and even corporate bond hedging nuance because this is a hypersensitive trade. And every unit of leverage you add on it adds new variables which were noise in your original math, but might start applying to the trade. Anyways, that's my just explanation of a trade I'm seeing happen. If I were taking a desk roll, this is something I would like to polish. I would actually like to do some potentially more research on corporate bond health and how it would impact a sort of trade like this. Anyways, I hope y'all have a great rest of your day and take care.